The private jet waited on the tarmac, but inside the mahogany boardroom, a terrifying silence had just set in. £4.2 billion was not temporarily tied up, and it was certainly not a mere corporate rounding error. That wealth was completely gone, evaporated in days by a singular mind that had forgotten how to hear the word no. Subscribe to understand why brilliance fails, because the cause of this massive collapse contradicts all market logic. This documentary is purely for educational purposes, relying on public records to analyze psychological financial flaws. Historical trends suggest that financial disasters are rarely caused by broken mathematics or faulty market algorithms. Yet a top executive surrounded by elite analysts managed to burn through billions while ignoring every obvious red flag. So how does someone with an Ivy League pedigree and infinite resources crash an entire empire into a mountain of debt? The answer is not hidden within complex derivative pricing models or sudden geopolitical supply chain disruptions. The failure was entirely psychological, an unseen cognitive blind spot triggered by a long streak of past victories. A former British Foreign Secretary who turned physician documented a specific mental shift caused by prolonged power. He called it Hubris Syndrome, proving that arrogance is not just a character flaw, but a true brain chemistry change. When an executive wins continuously for 10 years, the brain stops calculating risk and expects guaranteed victory. This condition fundamentally reduces a leader's capacity for empathy, and blinds them to basic statistical probabilities. You might wonder how much money your own overconfidence is silently costing you right now in your daily financial life. Let us look at what happened exactly 18 months prior to this specific £4.2 billion implosion. The executive began systematically firing all dissenting risk managers who dared to question the aggressive leverage. Those critical voices were replaced by agreeable subordinates who only validated exceptionally bad financial strategies. Creating this corporate echo chamber was the first domino to fall in a lethal chain reaction of normalized deviance. Small financial anomalies began appearing on the trading monitors, flashing red warnings of deep market instability. Credit spreads were widening rapidly across all major European markets, a classic symptom of looming liquidity crises. Yield curves were simultaneously inverting, signaling to any rational observer that a recession was absolutely imminent. Instead of treating these indicators as a four-alarm fire, the compromised board of directors called it the new normal. Psychological patterns indicate that when a group normalizes small deviations, catastrophic failure becomes inevitable. We see this in everyday life when investors ignore 3 consecutive months of falling profits, hoping for a miracle. The executive doubled down on catastrophic leveraged positions instead of cutting losses and closing the bad bets. This is the sunk cost fallacy, a destructive mental loop where you throw good money after clearly ruined investments. The motive was not strategic, driven purely by a desperate need to avoid the public humiliation of admitting a mistake. Everyday retail traders do this exact same thing when they refuse to sell a losing stock just to break even again. But there is a shocking twist to this drama that completely flips our standard assumption of corporate villains. We assume corrupt executives secretly know they are failing and cook the accounting books to hide the awful truth. Public filings reveal this particular chief executive never believed the trades were actually going to lose any money. They genuinely, pathologically believed they were smarter than the global market until the very last hour of the failure. The true villain of this story was not a lack of financial data, nor was it a sudden liquidity trap set by rival banks. It was an overwhelming excess of past success that made one human being feel entirely immortal against economic gravity. Our brains are simply not wired to process negative feedback properly after a long decade of uninterrupted gains. The breaking point finally arrived during a brutal 72-hour inflection point over a rainy bank holiday weekend. Margin calls hit the brokerage accounts simultaneously, demanding billions in liquid cash that simply did not exist. The psychological illusion shattered against cold market reality, leaving the executive paralyzed and completely cornered. In those final moments, no amount of past brilliance could stop the algorithmic liquidation of their entire portfolio. The yes men who had cheered on the reckless borrowing suddenly stopped answering their phones as the firm bled to death. It is easy to point fingers at billionaires, but this same cognitive trap ruins small businesses and personal savings. How do you protect yourself from a psychological disease that specifically targets people who are doing incredibly well? You must actively hack your own confirmation bias before making any major financial commitment or signing a large deal. There is a powerful technique called the pre-mortem strategy, designed to bypass your own natural overconfidence. Before finalizing an investment, you must imagine traveling 6 months into the future and finding out it has failed. Assume the catastrophe has already happened, and force yourself to write down the exact reasons why the plan fell apart. This exercise forces your brain to switch from a defensive optimistic posture to an active hunter of hidden liabilities. If that executive ran a pre-mortem, they would have seen the inverted yield curves and widening credit spreads easily. They would have realized that betting the firm on a single leveraged position was a total mathematical suicide mission. Instead, the absence of critical voices allowed a minor directional error to compound into a fatal company disaster. Let us connect the final pieces of this puzzle to understand the true cost of unchecked ego in high-stakes environments. Arrogance starts as a whisper, quietly convincing you that previous profits were purely due to your unmatched genius. It systematically isolates you from reality, encouraging you to fire anyone who brings you uncomfortable market facts. Finally, it tricks you into throwing good money into a sinking ship just to avoid admitting you read the charts poorly. Losing £4.2 billion was never about bad mathematics, faulty algorithms, or even poor market timing. The collapse was driven by an unchecked mind that fundamentally lost the ability to separate brilliance from sheer luck. When you remove dissenting opinions from your inner circle, you are not building a loyal team, you are building a trap. A boardroom filled with yes men is simply an echo chamber that amplifies your worst impulses until you hit a brick wall. The market does not care about your Ivy League degrees, your trading trophies, or your polished corporate reputation. It only responds to cold probabilities, punishing anyone who refuses to respect the signals of shifting trends. The next time you feel absolutely certain about a financial move, pause and ask if you are ignoring the true reality. Are you holding onto a losing position because it makes sense, or because your ego refuses to accept a temporary defeat? The most dangerous phrase in finance is believing that this time is different and that old rules no longer apply to you. Every fallen corporate empire started with a leader who believed they finally outsmarted the global financial system. To survive long-term, you must cultivate the humility to accept losses quickly and the wisdom to listen to harsh critics. Overconfidence blinds you to obvious red flags, transforming minor setbacks into catastrophic, unrecoverable disasters. The normalization of deviance will quietly convince you that an inverted yield curve is just a temporary market glitch. But the data eventually catches up, and when margin calls finally arrive, your arrogance will not cover the balance due. Unyielding past success eroded their risk capacity, turning the boardroom into a massive psychological echo chamber. Firing dissenting critics and doubling down on bad trades to protect their pride made a catastrophic collapse inevitable. Overconfidence turned clear market warnings into blind spots, forcing them to double down until the empire collapsed.